Feasibility class. I'm sorry that I'm not there with you in person, and I'm unable to be in front of a computer at the exact time that our class begins. So you'll get to see my face a little bit. I'm sorry. And I'll share some of the stuff on screen. We're going to get through a bunch of material, and this should be done in 3 separate recordings, recording 1, 2, and 3. So be on the lookout for each of the sections. I am sharing, and hopefully you can all see the screen, but I'm sharing the notes, the lecture notes from class 10, which is next week, not this week, but I figure it's a good time to go through it. So we're going to go through some of the notes here, and then I'm going to go back to the Excel model that we've been working with that you have in the Canvas module. So let's talk about hotel valuation. What is a cap rate? Cap rate is an unleveraged yield on an investment. Cap rates are used generally in real estate, and cap rates are not a very good way to evaluate and to understand valuation for hotels, because a cap rate basically assumes that the net operating income, the NOI, is going to be stable or stabilized. So if you have an office building and you're full with tenants, you know what the rental income is, you know roughly what your expenses are going to be, right? Your lease rental rates don't fluctuate day to day like they do in a hotel. You don't have a lot of staff. You may have some maintenance staff, some janitorial staff. You may have reception staff in the building, but not a lot of staff relative to a hotel. So despite that, cap rates are used anyway. And the way to understand what a cap rate is it's the net operating income divided by the value or the price. Okay, and all that it's doing is capitalizing. That's why it's cap rate. Cap is short for capitalization rate. It's capitalizing the net operating income. So if you take $1 million of net operating income and you assume that the cap rate is 10%, $1 million divided by 10% will be $10 million. I'm sure you're all upset that I can't call on you to answer the questions or to volunteer, so you'll be stuck just listening to me for the rest of this recording and for the next 2. So here I say a cap rate is defined as net operating income divided by purchase price or value of an asset, right? So the first question someone should ask is, which net operating income, right? Is there more than one? Well, of course there's more than one. We've been looking at projections, and we've been talking about projections for the last few weeks, where year 1 of a new hotel opening, right, is going to have a weaker performance because the occupancy hasn't fully ramped up and stabilized. Neither has the average daily rate nor the operating efficiencies. So if you were to take the net operating income from the first year of your projections model that each one of you 4 groups is doing, and you took that net operating income and put a market-driven cap rate or market-level cap rate on it, you would have a very low number. Now, if you then applied it to year 3, you would have a more normalized number. So when someone says cap rate, or the cap rate is 7%, the cap rate is 8%, the first question you should be asking is, why are you telling me this? Why do I care? But the second question you should be asking is on what year's net operating income? On last year? On this year? On this year's budget? On a future stabilized number, right? So who determined the net operating income? Does that have all the expenses deducted that it should have? When looking at an acquisition, you can look at the net operating income divided by the purchase price, right, that you're agreeing to pay, and that will tell you your cap rate. Cap rates for stabilized cap rates, meaning when the net operating income is stabilized, vary anywhere from 5 to 10%, depending on the type of asset. A lower cap rate, a lower cap rate means a higher value. A higher cap rate means a lower value. That's important to understand. Okay? And so why would someone pay or value a certain asset at a lower cap rate? Well, if it's a trophy asset, or if it's in a very desirable location, right, that would trade at a higher value, which means at a lower cap rate. Similarly, a tertiary market hotel, a roadside motel in the middle of nowhere, right, might trade or might be valued at a 10 to 12% cap rate, right, even though it might have good net operating income. So it's just a function of what are investors willing to pay. And if an investor is willing to pay a 7% cap rate, that means they're willing to accept a 7% yield or return on their investment. That is before any debt service. So cap rates do not factor in mortgage debt or interest expense or any kind of debt service. So again, a 7% cap rate deal is one where the net operating income divided by the purchase price or the value is 7%. We'll talk a little bit about an EBITDA multiple. Financial investors talk about EBITDA multiples more than real estate investors. So Wall Street people talk about EBITDA multiples, and it's kind of the inverse of a cap rate. An EBITDA multiple can help you understand how many times EBITDA, or the cash flow, is an investor willing to pay or has paid for an asset. So an EBITDA multiple can help you with an estimated valuation of a property, assuming you know what the EBITDA is, right? And again, applying an EBITDA multiple to year one EBITDA in our model or in our projections is going to give us a very low number because it's not stabilized. So you want to be careful the same way you'd ask about what do you mean by cap rate? Is it on year one NOI? Is it on last year, next year? Stabilized, you need to be doing the same thing if someone mentions an EBITDA multiple. EBITDA multiples do not factor in debt financing or depreciation expense. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Okay, the taxes that it's referring to are income taxes. The EBITDA, as you see on the various spreadsheets we've been using and in our projections, is after a deduction for property taxes, but not for income taxes. Why is that? Because property taxes are an expense of the property, not of the ownership entity. So value divided by EBITDA is the EBITDA multiple. An EBITDA multiple times EBITDA equals value. So a lot of investors will say, what multiple of EBITDA are you talking about? Are you buying this at 10 times EBITDA, which means they're buying it at 10 times what they think the annual stabilized EBITDA is. Okay, and again, just to give an example, if a property had a purchase price of $100 and is expected to generate $10 of EBITDA next year, the forward EBITDA multiple is 10 times, 100 divided by 10. Similarly, if the property is being purchased for $100 and is going to generate $8 next year, the EBITDA multiple is 12.5 times. That's 100 divided by 8. Okay, so it's basically the inverse of a cap rate, right? It's the valuation, the EBITDA multiple is the valuation divided by the EBITDA. Okay, so we talked a little bit about cap rates. How do we determine the exit cap rate? Now, first of all, what is an exit cap rate? An exit cap rate is the cap rate that you use when you assume a sale at the end of your investment period. So in the model we've been using, we've had 5 years of operations, right? So 2 years development period, then 5 years of operations, and then we assume a sale. Why would we assume a sale? Now's the point in the class when I'd normally wait for someone to volunteer an answer, but we can't do that. So I will volunteer an answer. We, even if we're making an investment or evaluating an investment that we think will be held for 50 years or 75 years or never sold, we're not in position to generate 50 years or 75 years of projections. So what's done in standard financial analysis is at the end of 5 years or 7 years or 10 years, you assume a sale of the property. And the sale implicitly assumes all of the future, the sales price implicitly assumes all of the future cash flows of the property, right? So your sales price should be very similar to if you actually wrote out another 99 years of projections and then discounted them back to today's value, right? Discounted them back using a discount rate. We'll talk a little bit about that in a few minutes. So exit cap rates can be highly judgmental, and the right way to determine an exit cap rate is to look at what exit cap rates have been on a historical basis. And the exit cap rate is the cap rate we're applying to the last year's net operating income. So our year 5 net operating income will then divide by the exit cap rate to come to a value. And I'll point this out in the model in it might be later in this first part of the class, or it might be in the second video recording for the class. So the appropriate way is to look historically and see what similar quality assets and similar type markets have traded for, right? And you can find this information. Some of it is publicly available. I find it oftentimes using CoStar or estimating. And some of the industry projections firms like CoStar, like Lark, like CBRE, provide estimates of cap rates, exit cap rates, and cap rates for a market as a whole, right? So they might for the overall Miami market or the overall Brickell market. And you should look and see what CoStar estimates for the Brickell cap rates, the downtown Miami and Brickell cap rates in the CoStar report for the Miami market that I've provided in the group project module. So how do we know if historical cap rates make sense? Well, history is one of the best estimates of where things will be in the future. So that's a good starting point. But then we run sensitivity analyses, right? We can use data tables and sensitivity tables in Excel to determine what the deal returns would look like and what the values would look like if the cap rate was a little bit higher or a little bit lower. And we want to understand, is the value in the deal driven very much by the exit cap rate? So if you assume a lower exit cap rate than market norms, you're going to create a higher value at the end of year 5 of your projections. And we're going to go through this in the Excel in a little bit. So if you're buying an asset, the buyer wants the cap rate to be high because higher cap rate means lower purchase price. Now a seller wants a low cap rate, right? Because they want the highest price. So if it's a low cap rate, right, applied to the same net operating income, again, net operating income divided by cap rate equals the value. Okay, then real estate investors and financial investors talk all the time about IRR, or internal rate of return. Hopefully some of you have heard of this. And an IRR calculates the annualized effective compounded return over a specified period of time, right? If you were in class, some of you would have your eyes glazed over and you'd be saying, what the hell does that mean? So let me try to make it really, really simple to understand, and hopefully I will succeed. You may have a transaction where there's very little income for 5 years, right? The return is very low, but you're able to sell for a very big price. So you'll get a huge payday at the end of year 5 of operations when you sell. And if you were to look at the annual return, right, if you were to look at the implied cap rate on year 1, year 2, year 3, it would be very low. In fact, during the development period, during your construction period, you're going to have negative cash flows, right? So the IRR is one that assumes what rate of return you're earning on your investment, whether it's an all cash investment or an equity investment, on an effective basis over the entire period you're holding the investment. So if the IRR was 15%, it's the same as if all of the investment that you made was earning an annualized and compounded 15% return, even though the return in year 1 of operations might be 2 or 3%, and then 5 or 6% the next year, and then 10 or 12% the next year, right, once you've stabilized. So there's a way of saying over the life of the investment, right, what is the return? The IRR calculations, and you can do this calculation easily in Excel, and I'm going to show you how to do that as well. The IRR calculations assume all cash that is available gets distributed and gets reinvested at the same rate. Okay, so if there's a cash distribution that's factored in, IRR calculations are used to evaluate the return on investment. And a higher IRR, all other things equal, is better than a lower IRR. Okay, the IRR doesn't necessarily take into account time value the same way a net present value is. So if you were to make an investment and sell it 6 months later, right, and make a good profit, your net present value might not be that high, but your internal rate of return might be extremely high because you earned a very high return on the investment that you put out, and that may be over a short time. So why are people focused on IRR? If you talk to private equity investors, a lot of real estate investors, people looking for investment partners, why do they care? Why do they talk about it? Well, a lot of investors end up getting increased returns, right? So I've done this. I've made investments in hotels, and each one of my investment ventures was structured that after we achieved a 10 or 12% return to all the equity, I would get a disproportionate amount of the upside, right? So people are looking at what is the IRR used as a measure of return. Okay, so the IRR can help you understand, is this a good return or a bad return relative to other investments? Okay, IRR does not factor in the level of risk. So if I presented to any one of you in the class 2 separate transactions, transaction 1 is an investment in US government treasury securities that are going to earn 5% a year. That has one risk profile. And then separately, I present to you a development deal to build a hotel in Brickell on our project site. And I say, I think that can generate a 15% return, right? You can't really compare the IRR on both of those transactions because one of them is extremely safe, right? Extremely comfortable. And if you own a portfolio of US government treasury securities, it's very liquid, meaning if you needed to exit the investment, there's a buyer. Now, for our development project in Brickell, our hotel development project in Brickell, if you were looking to sell it in the middle of construction, there are almost no buyers. If you were looking to sell it right away when you open, there's still not, part way into year 1, before you've stabilized, there's a bigger universe of buyers than during construction, right? But there's a certain risk profile, and a lot of people don't want to take a flyer on an investment that has that level of risk. The other thing is, if you're looking at IRR and someone is talking to you about IRR, again, internal rate of return, you want to understand, is this leveraged or unleveraged? Leveraged means, is this after debt, assuming there's mortgage debt or other debt in the capital structure, and comparing an unleveraged IRR to a leveraged IRR is an apples and potatoes comparison. So what is the net present value? Net present value is a calculation that allows you to calculate the value today by taking all of the future cash flows, including the sale value, and discounting them back today at a certain discount rate. Right? The discount rate is the measure of risk and is essentially the required return that an investor would have to have. So why are we discounting future cash flows, right? That means we're taking cash flows in the future. Say we're getting $100 in the future and we're valuing that at something less today. Why is that? The reason for that is we assume that if an investor was looking to make a 10% return on their deals, right, that the value of $100 a year from now is going to be worth less than the value of $100 today. The value of $100 5 years from now is going to be less than the value of $100 1 year from now or today. And we're going to go through that math in the Excel model. So net present value allows you to take all the future cash flows, whether it's 5 years of projections, whether it's 10 years, 20 years, 30 years, including any exit value, right? Any assumed sale in the future, and convert it into the value today. Okay, and we're going to do that. We're going to do that in the model, and you're going to do that, as the final step for your group project, because the only way you can determine if a project is feasible is to take all the projections and discount them at all the cash flows and projections, discount them back to today, right? And then compare that to the development cost. And if the net present value is above the development cost, it's feasible. And if the net present value is below the development cost, it is not feasible. So if the NPV is positive, even a little bit positive, it's a good deal because it returns all the investment plus the required return that an investor has. Meaning, if the discount rate is 10% and the NPV is 0, that means the investor got their money back and got a 10% return. Okay, so it's a little misleading because if you say a 0 NPV deal, sounds pretty shitty. I'm sure it doesn't sound good to any of you, but a 0 NPV deal is one that in corporate finance theory, an investor should do. Okay, so the NPV is the only metric that properly considers time value of money, adjusting for the riskiness of the investment. Okay, and again, I'll repeat what I said because I have it here in bold. Any project that has a positive NPV, in theory, it makes sense and should get done. Why do I say in theory? Well, we're using projections, right? We're not using historical actual cash flows. We're projecting year 1 to year 5 for our project. We're projecting what our development cost is going to be and when we're going to spend that during the development period. We're projecting what the exit value will be and the exit cap rate will be at the end of year 5 of operations. We're assuming that the discount rate, right, which is the rate that we need to compensate us for the risk of the investment, right, our required rate of return, that we've actually factored that in the right way. Now, discount rates could go higher if interest rates go higher, right? If investments become riskier for some reason or more costly, discount rates could be higher. So again, positive NPV on a deal, in theory, makes sense and should get done. So what is an equity multiple? This I'm going to go through quickly. You won't have to worry that much about it. This will not be on the final exam, and you can show this in your in your final report, but is not necessary. So an equity multiple shows the amount of return that you make on an equity investment. So if I was investing $1 and over time, how am I getting cash back? I'm getting net operating income, right? Or leveraged. If it's leveraged, it's the net operating income minus the interest expense, right? And I'm getting the residual value. So let's focus here. Hopefully you can see my cursor moving around. The unleveraged equity multiple is all of the net operating incomes during our projection period, so year 1, 2, 3, 4, 5, plus the residual value, right, which is the sale price minus the payoff, minus the payment of any transaction expenses, right, and that is divided by the total capital invested. So we can do this with leverage or without leverage, meaning with debt service or without debt service. And there are some investors that don't look at net present values at all, don't look at IRRs, and they say, if I'm in this for 10 years, I want to double my money. If I'm in this for 5 years, I want to double my money, right? So they can evaluate what the equity multiple is. If the equity multiple is 2.0, they've doubled their money. If it's 1.5 times, right, in this calculation, unleveraged equity multiple divided by the sum of the NOIs and the residual value, right, that number divided by total capital invested, if that is 1.5 times, that means you're making 1.5 times the money that you've invested. Now, that does not take into account time value of money. Right, so you might be looking at an equity multiple over 5 years, 7 years, 10 years, does not take into account time value of money. So again, here's an example. An investor purchases a hotel for $100, sells it 3 years later for $150, right? They generated $50 of operating cash flow, right? So that's the net operating income over 3 years. So they got $200 of total cash, right? And they had invested $100. So that's a 2 times equity multiple. Okay, example 2, investor purchases for $100, right? They fund 60 with a mortgage loan, so they have $40 of equity. They sell the hotel 3 years later for $150. So what do they have to do when they sell? They have $150, but they have to pay off $60 of debt, right? So here they're going to still have $200 of total returns, but they're going to have a 3.5x equity multiple. Again, you don't need to worry about this for the group project or the final exam, but it's useful to know. And again, the equity multiple does not factor in the time value of money or the timing on cash flows. So let's talk about cash on cash return. Cash on cash return is widely used by investors and is widely used by old school investors. So the cash on cash return is basically telling you how much cash you're actually putting in your pocket divided by the cash that you invested. So what's the formula for a cash on cash return? Sometimes it's called cash on cash yield. It's the annual NOI minus the annual debt service, right? So it's NOI minus interest expense and any principal amortization divided by the initial cash equity investment. Sometimes this is called an equity yield. So this may start very low and then ramp up, right? In our first year of operations, when we're not stabilized, what's going to happen? We're going to have a lower net operating income. We might even have more interest expense than we have net operating income. So our cash on cash return might be negative. By the time we're stabilized, right, we'll have a positive net operating income, hopefully higher than any interest expense we have, and we'll be able to see what the cash on cash return looks like. A lot of investors want to see cash on cash return stabilized at well above 10%, right? That means they're making 10% on their equity. And a lot of investors also do cash on cash as a back of the envelope calculation. So they're going to think about it and say, hey, I know what the year 3 NOI you're projecting is, I know what the interest expense is, and I know what the cash equity investment is. So I don't actually need to spend, I don't need to spend enormous amount of time building an IRR model and an NPV model. I can do this on the back of an envelope, right? And figure out I'm making a double digit return or a single digit return, and does that make sense? Okay, so let's do the quick example. If someone buys a property for $100, they pay 40 in cash, right? They pay 40 in cash. Sorry, that's actually a 60% LTV. That shouldn't say 40%. And the property generates $5 in cash flow, and the cash flow is NOI less the debt service, right? You have $5. You have $5 of cash flow divided by $40 of cash equity investment. So 5 divided by 40 is 12.5%, and that's what your cash on cash would be. So again, I apologize here where it says 40% LTV should say 60% LTV. So if the property is purchased for 100 and only $40 is paid in cash, that means it's 60% debt. Okay, and then again, if we generate $5 in cash flow, which is net operating income less interest expense, less debt service, the cash on cash is 5 divided by 40, which is 12.5%. Okay, so let's talk about how are hotels valued. Okay, some people value hotels on a cap rate basis. As I started this presentation today, it's not a great way to value hotels, even though people do it. And they do it because it's an easy way to compare. Remember, the cap rate is the unleveraged, meaning without debt, yield on an investment or on a purchase price. So you can compare, are you buying this at a 5% yield, at a 7% yield, and you can compare across different assets in different markets. Others will look at a per key value, right? Which is basically what is the value divided by the number of rooms, right? And that could be anywhere from 50,000 per room to 2 million per room for a luxury resort. Hold on just 1 second. Okay, sorry about that. So cap rates for different properties, again, could trade anywhere from 5 to 10%, right? Depending on, is it a cap rate on last year's income, on next year's income? Is the property renovated? Is it a luxury hotel? Is it new? Is it not? Does it need renovation? A lot of things go into it, which, same thing on a per key value, you can't actually tell what's happening by just looking at per key value. You need to get smarter about what condition is the asset in. Does it come with any restrictions or encumbrances? Was the property renovated? Does it need to be renovated? Is it performing well? Does it have the right management in place? A whole lot of things. So cap rate valuation utilizes the income that's being generated. Per key value has absolutely nothing to do with the net operating income or the revenue. It's basically just how much are you valuing each guest room, right? And per key values can be anywhere from 25,000 to 2 million a key. Discounted cash flow or net present value is the most appropriate and the most correct way to value a hotel, but it requires assumptions, right? It requires you to project the operations. It requires you to project the future sale value. It requires you to estimate a discount rate, right? Which is tricky. So let's get into some of the detail on how hotels are valued and why people would choose to pay a higher cap rate or a lower cap rate or a higher per key or lower per key. So the first is operating performance, right? Is there strong in place operating performance or not, right? And that can impact the value. What is the key count? What is the building program? So in addition to the number of room keys, right? How much meeting space? Is the meeting space good? Does the ballroom have high ceilings? Are there a lot of breakout rooms? What sort of restaurants are there? What sort of bars are there? All the things we've been talking about all semester, right? When you're trying to figure out comps, like, who's in your competitive set, you also want to understand what is your offering? What are you valuing? What are you looking at? And just the rooms doesn't tell you the full story, right? Do you have a rooftop bar? Do you have your own parking garage? Do you have an indoor pool, an outdoor pool? All these things go into hotel valuation. Location is important, right? Something on the beach is probably going to be valued higher than something, in the middle of nowhere. Full service, limited service, right? Full service means there are restaurants and oftentimes meeting space. Limited service is usually, there's usually a bed, right? There's a guest room. There may be a grab and go. That's what you have. Is it fee simple or leasehold? Leasehold means someone else owns the ground and you have a long-term usage right to buy it. So would you pay the same amount, right, if you don't own the land and you don't own it in perpetuity? Encumbered by management or flag, right? So is the property subject to an existing management agreement or a flag, which is a franchise agreement? That might make encumbered by a certain flag or franchise might make the property worth more or might make it worth less. It totally depends. Are there any additional development rights? Could you build more? Could you sell development rights to someone? What condition is the property in, right? How is the CapEx? Is there a PIP needed, right? So on change of control, on an acquisition of a hotel with a major brand attached, there's a property improvement plan, which is the brand checklist of all the things that the new buyer and new owner is going to need to do. What maintenance needs are there, right? So you're going to pay more for a hotel that's in pristine shape than one that needs a lot of work. And then is there a union agreement, right? If there's a union agreement, there are a lot of restrictions on what you can do from a labor management perspective. There are certain costs that you have to pay, certain benefits you have to pay, and certain work rules that you have to follow. Usually people will pay less for a hotel that has a union collective bargaining agreement. So when an appraiser looks at these things, right, and factors all this stuff in, there are three primary methodologies that they would use. One is the cost approach, right? One is the sales comparison approach, right? What have other things sold for, right? The first one, cost, is what would it cost to build, right? The second one, and sometimes that's difficult because if you're looking at hotels in a certain market and nothing new has been built in a while, right? The cost approach doesn't, it requires a lot of estimates. Sales comparison approach also, you have to determine which are comparable sales. And different people might have different opinions on that, just the same as all four of your groups came up with different competitive sets, right? You would have to come up with a list of who the sales are, like what properties sold that are comparable. And in some cases, you would have to make certain assumptions about, were they sold subject to any financing in place? Were they sold and they needed a lot of capital improvements? Were they sold and they were subject to management agreements or franchise agreements? And then the third approach is the income capitalization approach. Income capitalization approach has two different ways to do it. One is the cap rate approach, and we'll talk about that in a minute, and the other is the net present value or discounted cash flow approach. So again, the most accurate but requires the biggest number of assumptions is the income capitalization approach, usually followed by the sales comparison approach, because you can get grounded in an understanding of what is the what are other hotels nearby in the area or similar selling for, what have they sold for, and that's actual, right, versus income capitalization where you have to come up with assumptions for the future. So let's talk about this cost approach. How much would it cost to build or to replace the hotel? That's to buy the land, hard costs, soft costs, all of the interest expense, everything, if you were going to build and replace it. Now, what's really tricky about this is you would not replace, you would not replace a 30-year-old hotel, meaning you would not build it to a 30-year-old standard. You would build it to a new standard. So this is more of a theoretical, what would it cost to build this same product new? Then when we look at the sales comparison approach, right, we can look at the sales price, we can look at the price per key, we can look at the cap rates in some cases where we can get information on what the NOI has been. And then an appraiser will take the sales comparables and will adjust them for age, physical quality, right, the property condition, any branding, amenities, if there's assumed debt, if there are leases, if there are tax abatements, right? So they adjust upwards or downwards, right, to try and get to understand, like, how comparable are these other sales to your property. Again, in looking at comparable sales, you want to understand, was the sale encumbered by management or brand? Right? Meaning, do any of those agreements have to stay in place? What physical condition was the property in? Is there a brand PIP? Meaning, how much capital and how much do you have to spend to improve the property to brand standards? Was the hotel owned in fee simple? Was it subject to a ground lease or a space lease? Did the hotel have any extra development rights? Right, so sales comparison approach can give you bad conclusions if you're looking at complex hotels or if they're not really comparable. So we come to the income capitalization approach, right? This is what we've been doing in our class. We're forecasting revenue and expense, right, to get to net operating income. Normally it's done for a 5-year period or a 10-year period. We're assuming a residual cap rate, an exit cap rate to the final year of net operating income. And then we're going to discount each period's income back to today at a discount rate equal to the weighted average cost of capital, right? Weighted average cost of capital is how much return do we need to have on our equity invested and how much return is needed for the debt. Okay, so weighted average cost of capital is the blended cost of our capital, and that's the discount rate. So income capitalization is the most often used and is the most thorough and the best for anyone looking at income producing investments like a hotel. Now, the direct capitalization rate is when you don't do multi-year projections and you just say, I'm going to take the NOI, the net operating income, divided by a cap rate, right? That could be the in-place net operating income, the stabilized net operating income, divided by a cap rate to come to a value. It's much easier to do. It requires you to estimate a net operating income for a single period and the cap rate, right? Instead of all the other assumptions that we're making and all the projections we're doing for our group project. Okay, so the income capitalization issues, we talked about it earlier. It requires the creation of future projections, including revenue, including expense, and including NOI. The example that I've used before in class and that I like to use is if people don't know what they're having for dinner on Saturday night, how are they going to determine 5 years of projections or 7 years of projections of operating expenses for a hotel or of what the occupancies will look like? We don't, right? We make the best assumptions and projections we can make given the data and given the research that we do. The income capitalization approach also requires assumptions on capitalization. So if we're looking at a leveraged return, a leveraged net present value, it's how much debt are we taking on, right? As a result of how much debt, how much equity, and then what's the cost of debt? What's our interest? What's their interest rate? So to create a valuation, right, an analyst, an appraiser, or you have to convert the projected NOI in the future into an estimate of value, right? So we're going to do this using the discounted cash flow method. And the end result is we can turn the entire set of projections into a single value. And I'm going to show you in the Excel in the second part of this. But if the economic value exceeds the projected cost, the project is feasible. That's the entire class, right? We're spending an entire semester talking about this, right? If the value is higher than the cost, the project is feasible, right? And the question is, how do we determine what the value is and how do we determine the cost? The good news is the projected cost for your group project I've given you, right? That's a defined number. So all you have to determine is the economic value. Now, I guarantee you 4 different groups, and we're going to present, we'll see these presentations in class, 4 different groups are going to have 4 different economic values. Again, for the same project. And it's the same reason that you have 4 separate competitive sets, right? The projections, right, should be grounded in reality, but have subjectivity to them. Someone might think you're going to exceed the competitors. Someone might think you're going to lag or be below the competitors. Someone might think you're right on par with the competitors, right? And there's no right or wrong answer, right? If there was, like, no one would be doing feasibility analysis. We would just feed it into a computer, put a few assumptions in, and it would spit out, hey, this is a good deal, this is a bad deal. But there's a whole bunch of judgment that goes into this, and the judgment should be grounded in reality. So let's talk a little more about the exit cap rate. We're going to think about using a residual cap rate or exit cap rate. It's the same, 2 ways to say the same thing. We're going to use it based on historical and projected data. We're going to look at comparable sales. We're going to use some practical judgment because we need to make an assumption, and our assumption is going to be 5 or 10 years or something like that in the future. We don't know where valuation levels will be, right? And as we know, numerous things in the economy and capital markets can change over a 5 to 10 year period, right? There could be things like COVID. There could be things like recessions, big increases in interest rates, economic ups and economic downs. A lot of investors just cheat, right? And a lot of feasibility analysts just cheat, and they say if the cap rates today are 6%, then we'll assume they're 7%, when we're exiting. Or if we're making an investment in buying something at an 8% cap rate, we'll assume that our exit cap rate is 9%. And that's widely done, and there's no science behind it. Just assumes that it's a little more risky in the future than is today. Now, CoStar, CBRE, and other firms track historical cap rates, and some of them project future cap rates. So you can also take a look and see what they're projecting for the market and sub-market that you're talking about, and for the chain scale, right? So cap rates are usually lower for luxury hotels versus economy hotels because investors are willing to pay a higher multiple, right, and pay a lower cap rate and take a lower yield for investing in a Four Seasons than an Econo Lodge. Okay, so let's talk about the discount rate. And we're going to come soon to the end of these slides, and will be the end of the first part of the lecture for today's class. So determining the discount rate, the weighted average cost of capital, means you have to estimate the percent of debt and the percent of equity, the cost of debt, and the required return on equity. Okay, the cost of debt should be adjusted for the income tax rate, but a lot of real estate ventures are done with non-taxable investment entities, so oftentimes the discount rate is on a pre-tax basis. The discount rate must factor in, right, and that means the percentage return on equity must factor in all the risk of hotel development. which could be a lot. So let's see how this calculation works. Weighted average cost of capital. We said on the previous page, it's the cost of equity plus the cost of debt. So here in this example, if the hotel development is $90 million, 65% of which is debt, and an 8% interest rate, 35% is equity, and the equity investor says, I need to make a 20% return on my money. So debt is 65% times 8% interest, meaning you need a 5.2% return on the debt. Equity is 35% of the total capitalization times 20%, which means you need a 7% return on the equity, right? So the 5.2% plus 7% is 12.2%. So blended, you need 12.2%, right? And again, this is 35% of the total capitalization of the total deal capital is equity, requiring 20%. And 65% is debt, where you're paying the lender 8%. So overall, you need a 12.2% return to justify making this investment. Therefore, the discount rate is 12.2%. So final point here on the nature of hotel investments, right? Hotel investments are real estate investments, but also have an operating business component. Someone could be a very good real estate investor, but doesn't understand hotel operations and how hotels need to be managed, and that will not work well. So hotels are more risky and more variable as a generalization than office investments or multifamily investments or retail investments, where you have tenants, where you have, in multifamily, you oftentimes have 1-year tenants. In office, you have 5, 7, or 10-year tenants. In hotel, your tenants leave every day, right? And your ADR resets every day, and you have to get new occupancy, right? And at the same time, you have a lot of employees in the hotel. So I'm going to close out of this again, for anyone pulling it down, it says next week's date, class 10 and 717, but this is available on Canvas in the class modules. So I'm going to close this. I'm going to stop sharing, and we're getting close to an hour in. I'm going to put an end to part 1 of the lecture here, and I'm going to pick up part 2 with the Excel model that we've been working on. So I'm going to stop the recording.